Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Frank Holmes, the CEO and Chief Investment Officer of U.S. Global Funds. And Frank's been on with us many times in the past, and always good to have him on. He is a person who I think thinks outside of the box. He's really an innovative, creative thinker, and has done very, very well with his group of funds under the U.S. Global umbrella. Thanks for joining me again, Frank. It's good to have you with me.
Well, it's always great to be on your show, Jay.
Always good to have you, and I should tell our listeners before we get started, it's usfunds.com. Is that where they can go to keep up with all you're doing?
They can, and they can subscribe to the Investor Alert, which we publish, and it's about 40,000 readers in 180 countries every week.
Well, it's quite an extensive piece that you put out every week, and I'm looking at last week's, and I want to get into some of the topics that you talked about last week. In particular, the one that's small cap mining stocks, big time opportunity, and you're talking about the GDXJ and the dislocations that have occurred there. But before we get into those issues, I would like to ask you to talk a little bit about your new ETF. That you're starting. I guess when is it going to be launched? And tell us a little about it, Frank. The name is Go Gold. I think the symbol will be GOAU, appropriately so.
Well, thank you, and it's exactly that. We've won many awards for active gold fund managers. In fact, someone told me that we've won the most Lipper awards in that category for the past 25 years, and so we're seeing that mutual funds are being Uberized by ETFs, and then we witnessed what took place for our active funds being swashed around by money flows due to GDXJ. And GDXJ last year captured $5 billion of money going into small cap, mid cap gold producers, and they grew too successful. It's like the notorious big rap song in the late 90s, more money, more problems.
Yeah.
And so they've had to turn around and blow out $3 billion worth the junior mining stocks, and this has had a tsunami impact. And good gold stocks versus bad, they've just all been hurt. So what took 1 year basically is being unloaded in 6 weeks. And that's why you've seen this bifurcation with gold rising and the gold stock selling off. But I said in that article is that this is back up your truck, baby, back it up. And there's so many great gold stocks that have fallen for no fundamental reason. Companies and quant models that we have applied to look at our holdings are giving stocks like Pondex, which has free cash flow of $10 million. The revenue for the last quarter is greater than the average for the 4 quarters, which is very positive because most of the mining companies can't show that growth. And they had a big capex expand with their production. But that stock had fallen to its lows 50%, all because of money flows of the GXJ repositioning for big cap gold stocks. And so we see that this is a big opportunity, and investors should just understand it's a very successful ETF. The GDXJ is probably it grew faster with money than the industry grew.
Mm-hmm. I think another one that you mentioned in your article was West Dome, perhaps. Is that another one that you think has some opportunities now with this dislocation?
Yes, I think Pondex, West Dome, there is a handful of them that have very attractive projects. So something's consistent. They all have high grade. They all have growth in reserves, exploration success, and growth and potential for growth for more and more reserves. And I love seeing those high grade stories where the revenue is growing faster from production and the reserves are growing even faster. So it's a perfect profile. They've been sold down, back it up, and there's probably about 15 of them that have been dislocated. And then what's happened, Jay, is that the tsunami effect has hit stocks that are not even in GDXJ. and even some of the energy names are getting hurt because people are afraid, and they just didn't understand why these stocks are getting pulverized. And so I think trying to explain to shareholders and investors that there's just wonderful opportunities here, and for not just grassroots exploration, but developing growth stories.
Indeed. So this is really sort of a unique opportunity, but how do you see the gold markets and the gold share markets overall relative? I mean, we've had this tremendous bull market in equities for a long time now, and we had Michael Oliver talking to us a little while ago, technical analyst. He's turning, he's very, very cautious in the equity market overall and very bullish. He thinks we're in a new bull market, a relatively new bull market in gold, and the equity markets as a rule are getting very, very long in the tooth. Generally speaking, what are your thoughts about the gold bullion and the gold share markets in general, above and beyond this?
For investors is that the gold stocks always do so much better when gold is running and the stock market is running. They just accelerate at a 2 to 3 to 1, 3, like it's a factor of 3 times what the S&P does. Now, the S&P is getting crushed and gold is rising. The gold stocks, they'll perform better, but they never give you that robustness. From 2002 right through the 2007, we had a strong bull market in stocks and gold prices. So it was a huge run in that gold stock place. But what I think is important is this GDXJ, and what we see is that the GDX and GDXJ have nothing to do with intelligent reasons to own a gold stock. It's just, here's a basket of names, who's most liquid, we own them. And what I've launched is coming up next week, ring the bell next Thursday, is Go AU, and it is an intelligent way of looking at gold stocks. I take the 88 global gold producers and distill them down to 28 names, and it is basically like artificial intelligence approach. And artificial intelligence does not look for an explicit black and white decision. It looks for a statistical heuristic. That means that if A and B happens, the C probability is 80-90%. And that's how we run our active funds, and we've done well with that thought process. So I've been spent 8,000 hours memorializing, trying to understand, putting math to the best stocks we picked. And we went back over 40 quarters, and we came up with a structure that is 30% royalty companies. So it's 10% Franco, 10% Royal, and 10% Silver Wheaton, and they rebalance. And they rebalance each quarter because we found that some quarters one far outperforms the other. And there's some real fundamental factors why the royalty companies do so well. They actually outperform in the down markets, and they perform with the up markets. And that's what's really important when you want to try to outperform. And when we did our Moneyball mathematics of saying how does it compare to the GDX and GDXJ, well, we outperform 95% of the time on rolling 12-month periods. So intelligent, rational reasons for owning these stocks, which stocks to own, and then you have to recalibrate every month. And so I'm very excited about it. 28 names, 30% are going to be royalty companies. Then you can have 25 names, and they're going to be tiered based on their fundamental factors and their liquidity factors. We can go down to $200 million market caps. The average is pushing for small cap $700 million now. But the model catches any sell-offs where headline news can knock a gold stock down, but the fundamentals are in place, and they're the ones, Jay, that always rebound back.
What was that? I didn't catch that, Frank.
So when we have a company like, say, Klondex, where the revenue of the last quarter is over 4 quarters is positive, free cash flow, that when they get sold off because of the GDXJ phenomena or some negative headline news, those stocks are the best to buy because they give you an easy opportunity and they surge on the rebound. It's when you see the revenue per share last quarter or 4 quarters goes down relative to the peers, or they have a environmental problem, or they have a delay in their advancing their projects, etc. Those factors, based on 100 case studies, show that you've got to stay away from those names. That's the sort of artificial intelligence of looking at the space. And that's what I think we're trying to apply, our sort of a quant math approach for something that's very intelligent and it's documented. And by the way, Jay, we did this with our JETS ETF. We said that we heard all the negative news on Warren Buffett didn't like the airline industry, and we said, no, he's going to love these stocks because Southwest Airlines has 36% returns on invested capital. This industry now has a moat around it. It's shareholder focused, buying back their stock and increasing their dividend, paying down their debt. And they built a moat around that. And we overloaded the four horsemen, that is Southwest, United, and Delta, and American. And guess what? Buffett has now, in the past 9 months, invested $10 billion in those four names. That ETF has been a success for investors, and that sort of concept of thinking about it, we look at the royalty companies as being the horsemen of the industry.
Well, Frank, let me ask you, what sort of market cap, what's the smallest market cap companies that will fit into your new gold ETF? 200 million. 200 million, okay.
And so it's $200 million, and that way you don't run into the problem of enterprise value. So if they had some debt, etc., then they could still qualify. But it's where you must make sure you can have that liquidity. You don't get into the GDXJ problem. And we scaled it up to $10 billion, and our system works.
Up to $10 billion, the top end, huh? So,
we were say, well, how does it grow with the industry? Does it contract with the industry? It's like an accordion. So we're very happy about it. I mean, it's going to come with 60 basis points to get something that's going to outperform all the gold fund managers of Canada. We've done the test, and no one beats it. Nobody.
Got 30%. You've got 30% in royalty companies. Is that pretty much a locked in thing, or is that variable?
Yes, that's locked in, and unless Cisco's grow bigger than those three, there are three big liquid names, and we also we have other fundamental factors, Jay, that showed up. Rising price to book value. So what we noticed, revenue per employee. So when we looked at the royalty companies, you see Newmont as $200,000 of revenue per employee. Franco-Nevada, which is a royalty on Newmont's assets, has $20 million of revenue per employee. So it's performed. When I look at price to book, you can see that every time Franco-Nevada does a financing, it's accretive, so you have rising price to book value. Newmont has all these charges, they have falling price to book. Franco-Nevada's far outperformed over the past 4 and 5 years. It's gone up, whereas these other gold stocks have gone down. They're only rebounding. So it's trying to recognize, what are the factors that the quants look at that buy these stocks. If you look at Amazon has rising revenue every quarter over the average of 4 quarters, and has rising price to book. The cash flow is volatile because they're always spending money growing, but those factors allow it to trade at a higher multiple. So the Franco-Nevada trades at a higher multiple, and also Franco-Nevada gives you a frontier approach towards the junior mining because they have royalties on a lot of these junior mines. And when they do, they have the good housekeeping seal. So I'm de-risking a junior mining producer.
Sure, no question. Well, so you rebalance at the end of the month, Frank, right?
No, once a quarter. Once a quarter. It rebalances. Once a quarter. We looked at once a month, but there's just too much friction. And the reason for that, Jay, is the volatility of currencies. So this particular fund can capture the momentum of the South African rand falling. So during the fourth quarter of 2015, the South African rand was falling, and the first it impacts the stock prices, and then all of a sudden the results come out, and they have rising profit margins. And those stocks had the best first quarter of 2016. And then you can see in the second half of the year, the rand rallied, and the South African stocks underperformed. And all of a sudden, the model was out of South Africa. It was more into Australia and Canadians. So now today we have a weak Canadian dollar, then the Canadian gold stocks can show up. So it's able to catch the momentum of currency swings, and it's always 3 months behind the momentum of that change. But usually, when a currency starts in a decline or rising scenario, it lasts at least for 9 months. So it's able to capture those runs.
I see. Well, what about black swans, Frank, that might just, I mean, you talked about an environmental issue. I guess some of them you can sort of see coming, but does your model capture things? I mean, how can it capture the unexpected? I guess it probably can't. You just rebalance at the end of the quarter then, or how does that work?
Yeah, there's some rules in there. There are merger of acquisitions that come in. There's some rules of how we manage an acquisition. So it has lots of rules to deal with that. But black swans are black swans. There's just math to them, and there's 7 factors that will knock a stock down for within 2 weeks, and it usually stays down for 12 months to 18 months. And if the revenue or production per share falls below the 4-quarter average, those stocks get crushed. And so we don't stick around listening to them repair their company, because math says they're in the penalty box for 18 months. Just math, nothing but it's Moneyball. And so the model then gets rid of those stocks.
You have, I think that your objectivity with respect to the gold markets and so forth is enhanced in the eyes of many, including yours truly, by the fact that you have, under your U.S. global umbrella, a lot of different sectors that you're involved with. So I'd like to ask you your sense of the gold market now. Do you think that we are in a prolonged or early stages of a gold bull market?
Yeah, I think we're in a bull market. You just take a look at rates rising, but the 10-year governments are still, and 5-year and 2-year are still negative yields.
Yeah.
For your listeners, that is, we take what the government is saying, please buy my 2-year government bonds, deduct the CPI number, and is the rate of return the government's offering is positive or negative? Well, historically, whenever it's negative, gold rallies. Right. And you're seeing that they're still negative, especially the 2-year and the 5-year, which is important for currencies, how they parity trade with each other. They're negative. So this is bullish for gold, and now we're just ending in Ramadan, and it's always the first leg of gold rising, and we're going to come into a wedding season in India, and then we're going to have the season of lights, the Diwali season, then we're going to have Christmas. So I think we have a good run of the love trade, and if you take a look at the GDPs per capita, and you look at Chindia ETF, which is 40% of the world's population, China and India, well, this particular ETF is outperformed the S&P 2-to-1. Look at the past year. So it means they have a better economy. They have economic activity. There's the wisdom of crowds would suggest that. So prosperity that way is usually relates to better gold consumption, and we've seen that in India, that a year ago the gold consumption had declined, and there was a big chase of the currency and the re-rating the currency. But they're back, and there's been a rebound in the consumption of bullion.
Are you pretty bullish on India overall, Frank?
I am. I am. You've got so many smart people. Who's the CEO of Microsoft? Mm-hmm. He's Indian. Who's the CEO of Pepsi? She's Indian. Who's the CEO of Google? He's Indian. Yep.
Yeah, I hadn't thought of it.
India.
Yeah. Well, they certainly they did some things that were objectionable to, at least ideologically to me, when they decided they wanted to take currency away from people. But what are your thoughts on that? I mean, we're moving away from currency in our pockets, right? We're moving towards a digital world more and more with
right. And then the hackers will be stealing our wallets. Like that's what they want to go after. The bitcoins are in wallets too. I think that what he was really trying to do was catch, for the election, all the illegal money that's in baskets of how they go and pay out people for politicians, etc., and to catch them flat-footed. That's what we really want to do. The very poor people in the agricultural region were harmed, but the millennials all want it because it was more emotional against the political corruption, and I think it achieved that. It's a wake-up call to them. Don't try it, play games with the paper and issue a new paper. And they had to justify where their money came from. Well, they lost 30% of their money. Well, the government, the amount of money that flowed into the government swelled. It helped all their cash flow, and they were able to spank a lot of naughty people.
Frank, with just a minute or so left here, talk to us a little bit about your JETS ETF. How has that performed?
A 52-week high. So I'm excited about that. It's up about 25% since launching it. So I think that, it's done its job. And that's what it's supposed to do. It's outperformed the S&P, and now I have Warren Buffett believing in the industry, and he particularly believes that the 40% of my fund, which is all quant-driven, he loves the same quant math, and he's a big buyer. So I think it's very positive. And if you look at global demographics, if there's more middle-class Chinese people traveling the world, that's why American Airlines goes into China. I think it's all very positive long-term trend for the airlines industry. And every negative news about some stupid stewardess or person at United or American or whatever they do, it only benefits us because they have to clean up their act and scramble and give better benefits to people flying and be more sensitive that it hurts their stock. So I think that bad news is good news in the airline industry now.
All right, we'll have to leave it at that, Frank. Thank you very much for being with us again. It's always a pleasure having you on. Your insights are always of great value, so I hope we can do it again sometime in the near future.